Money runs on trust. When that trust breaks, everything falls apart. History is full of moments when economies collapsed. Not because people stopped working, but because they stopped believing. In this video, we'll explore 5 of the most dramatic economic crashouts in history, from the Great Depression to modern financial meltdowns, and the hidden psychology that fueled them. These aren't just numbers or stock charts. They're stories of fear, greed, and human behavior under pressure. Let's begin. The 2008 global financial crisis.
Traders saying this is the craziest day they have ever seen in these markets. Veteran traders saying they've never seen anything like it. The movement in oil prices.
The 2008 collapse was the most complex financial disaster in modern history, but at its core it was built on a simple lie. Housing always goes up. Banks issued millions of mortgages to people who couldn't afford them, called subprime loans. These risky loans were bundled into financial products called mortgage-backed securities and CDOS, which were then sold to investors worldwide. Rating agencies labeled these toxic assets as AAA, the safest rating possible. The global financial system became a tower made of dynamite, and everyone pretended it was steel. When homeowners began defaulting, the entire structure collapsed. Lehman Brothers and the 158-year-old bank filed for bankruptcy. Other banks like AIG, Citigroup, and Merrill Lynch required massive bailouts. Stock markets plunged nearly 40%. Global trade dropped for the first time since World War II. This wasn't just an American crisis. Europe, Asia, and emerging markets were all exposed because they had bought U.S. mortgage products. Millions lost homes. Millions lost jobs. The psychological factor? Greed disguised as innovation. Financial experts believed mathematical models could eliminate risk, so they stopped thinking like humans and started thinking like machines. But no model can eliminate the one variable that destroys every bubble: human overconfidence. The Asian financial crisis. The Asian financial crisis was a masterclass in how interconnected global economies really are. In the early 1990s, Southeast Asian nations grew rapidly by attracting foreign investment. Thailand, Malaysia, Indonesia, and South Korea became known as the Asian Tigers. Their currencies were pegged to the US dollar. This gave investors confidence until it became clear the system was unstable. These countries borrowed massive amounts of short-term foreign debt, often in dollars, but invested in risky domestic real estate and infrastructure projects that produced little return. By 1996, Thailand's property market was flooded with unfinished buildings. Debt-to-GDP ratios exploded. When the US dollar strengthened, Asian countries found it harder to repay their dollar-denominated loans. And when investors sensed danger, they panicked. On July 2, 1997, Thailand was forced to abandon its currency peg. The baht collapsed instantly. That single event triggered a regional domino effect. Indonesia's rupiah dropped over 80%. South Korea required a $58 billion IMF bailout. The largest in history at the time, Malaysia imposed capital controls to stop money from leaving the country. Millions of people fell into poverty. Corporations went bankrupt. Entire governments faced political unrest. The psychology behind it? Fear spreads faster than finance. Investors didn't wait to see facts. They ran before others could. And the crisis revealed an uncomfortable truth. If your economy depends too much on foreign money, that money can disappear overnight. The COVID-19 economic shock. Unlike previous crashes, the COVID-19 shock wasn't caused by speculation or financial engineering. It was caused by forced paralysis, the world economy hitting a sudden, unnatural stop. Within weeks of the first lockdowns in 2020, global supply chains collapsed. Factories shut down. Airlines grounded 17,000 planes. Oil demand fell so sharp, U.S. oil futures briefly traded at negative prices, meaning producers were paying buyers to take oil away. Restaurants, hotels, and small businesses shut down overnight. Unemployment in the U.S. jumped to 14.7%, the highest since the Great Depression. Governments responded with unprecedented stimulus spending. The U.S. injected over $5 trillion. Europe launched multi-trillion euro rescue packages. Central banks slashed interest rates to near zero. These actions prevented a full collapse, but they created new problems: inflation, labor shortages, asset bubbles in tech and housing. Tech stocks like Zoom, Tesla, and Shopify exploded, only to crash heavily later. Meanwhile, supply chain chaos, especially in semiconductors, disrupted global manufacturing for years. The core psychological driver of this crash was fear. Fear of the unknown, fear of illness, fear of uncertainty. It reminded the world that even the most advanced economic systems are fragile, and one external shock can bring everything to a halt. The Great Depression, 1929 to 1939. The Great Depression didn't just appear. It was engineered by a dangerous combination of speculation, leverage, and national overconfidence. During the 1920s, Americans bought stocks on margin, meaning they borrowed up to 90% of the money. If a stock cost $100, people paid just $10 and borrowed the rest. As long as the market rose, profits were enormous, but the entire system depended on constant optimism. Banks fueled this mania by giving loans to anyone with a pulse. Manufacturing output increased, but wages barely moved. People didn't care. They believed the stock market was the economy. Then came Black Thursday, October 24th, 1929. Investors suddenly tried to sell, but no one wanted to buy. 3 days later, Black Monday, followed by Black Tuesday, wiped out billions. When people rushed to pull their money from banks, over 9,000 banks collapsed. Not because they ran out of money, but because everyone asked for their money at the same time. Unemployment skyrocketed to 25%. In industrial centers like Cleveland and Detroit, it reached 50%. Farmers in the Midwest were hit by another crisis, the Dust Bowl, a massive drought that destroyed agriculture. In Oklahoma alone, 1 in 8 people abandoned their homes. The psychological collapse was even more devastating than the financial one. People stopped spending, businesses stopped hiring, banks stopped lending, and fear became the national currency. The Depression only ended when World War II forced governments to spend at unprecedented levels, and it left a painful lesson. When greed goes unchecked and risk is ignored, the fall is always brutal and always faster than anyone expects. The Japanese asset bubble. Japan's crisis began with victory. In the 1980s, Japan became an economic superpower, booming exports, cutting-edge technology, and rising global influence. But the real danger was the belief that Japan couldn't fail. The Bank of Japan kept interest rates extremely low, encouraging companies and individuals to borrow aggressively. Corporations bought both land and stocks as if they could only go up. At the bubble's peak, Tokyo's real estate reached valuations that made no logical sense. For example, the land under the Tokyo Imperial Palace was valued higher than all the real estate in Canada. Office space in Tokyo's business district cost 350 times more than comparable space in Manhattan. Companies use their inflated property values as collateral for even more loans, a positive feedback loop. Then, in 1989, the central bank increased interest rates to cool speculation. That single decision was enough to trigger the collapse. Property prices fell more than 70%. The Nikkei stock index dropped from 39,000 to 15,000. Banks were left with mountains of bad loans. Instead of admitting the losses, they covered them up, creating tens of thousands of zombie companies that existed only on paper. Japan entered what economists call the lost decade. But in truth, it lasted almost 25 years. Even today, Japan is still fighting deflationary pressure created by that era, a reminder that a crash can scar an entire generation. And the psychological mistake behind it all was simple, the assumption that land prices never fall. When everyone believes an asset is risk-free, it becomes the most dangerous investment of all. Across every crash in history, the same pattern repeats: euphoria, denial, panic, collapse, and regret. Economies may change, gold to dollars, dollars to crypto, but human nature doesn't. Every crash begins not with numbers, but with feelings. And every recovery starts when people begin to trust again. The real question is, in the next boom, will we remember these lessons? Or will history repeat itself? Which crash do you think taught the world the hardest lesson? Tell me in the comments, and also don't forget to subscribe for more economic knowledge.